In this video, we will explain how taxes work, provide tips for minimizing your tax bill, and discuss why the poor pay taxes while the rich may not. Hello, and welcome to this video on the basics of taxes. Whether you are a student, a professional, or a retiree, taxes are an essential part of your financial life. Hi, this is Micaiah Wealth Building. We are the best YouTube channel for business and money-related content. Therefore, let's start with the fundamentals. What are taxes? Taxes are mandatory payments made by individuals and businesses to the government to finance public goods and services. Public goods and services include things like infrastructure, healthcare, education, and national defense. Taxes are essential for maintaining the standard of living in a society. Now, let's talk about how taxes work. The government sets tax rates based on an individual's income and the type of income they earn. The tax rate varies depending on the level of income. For example, someone with a high income will pay a higher tax rate than someone with a lower income. There are different types of taxes. The most common ones are income tax, sales tax, property tax, and payroll tax. Income tax is a tax on an individual's income, while sales tax is a tax on goods and services. Property tax is a tax on the value of property, and payroll tax is a tax on employee wages. Now, let's talk about how to minimize your tax bill. One way to minimize your tax bill is by taking advantage of tax deductions and tax credits. Tax deductions are expenses that reduce your taxable income, while tax credits reduce the amount of tax you owe. You can also contribute to tax-advantaged accounts, such as a 401k or an IRA, which can lower your taxable income. Now, let's discuss why the poor pay taxes while the rich may not. The answer to this question is complicated, but one reason is that the poor often have fewer resources to take advantage of tax deductions and credits. The tax system also tends to favor the wealthy, who can use various loopholes to minimize their tax bill. The concept of why the poor pays taxes while the rich may not is a complicated issue, but there are several reasons for this discrepancy in the tax system. One of the reasons is that the poor often have fewer resources and opportunities to take advantage of tax deductions and credits that could lower their tax burden. In general, tax deductions and credits are intended to provide a tax break for expenses that are necessary for a person's livelihood, such as healthcare expenses or educational expenses. However, these deductions and credits can be complex and difficult to navigate, especially for those who are not well versed in tax law. This can make it difficult for those with fewer resources, including the poor, to take full advantage of the available tax breaks. Another reason why the poor pay more taxes than the rich is that the tax system tends to favor the wealthy. Wealthy individuals can use various loopholes and tax planning strategies to minimize their tax bill. For example, high-income earners may take advantage of tax deductions for charitable donations or investments in tax-advantaged retirement accounts. They may also engage in tax planning strategies such as income shifting or using offshore tax havens to reduce their taxable income. According to recent data from the Institute on Taxation and Economic Policy, ITEP, the top 1% of income earners in the U.S. paid an average federal tax rate of 24.7% in 2019. In contrast, the bottom 20% of income earners paid an average federal tax rate of 7.5%. The ITEP also found that many large corporations, including Amazon, Netflix, and Delta Airlines, paid little to no federal income tax in recent years. One reason for this discrepancy is that the tax system is often more lenient towards corporations and wealthy individuals. For example, corporations can deduct various expenses, such as CEO salaries, from their taxable income, which can significantly reduce their tax liability. Additionally, many wealthy individuals have access to resources, such as tax lawyers and accountants, who can help them take advantage of various tax planning strategies. However, it is important to note that not all wealthy individuals and corporations engage in tax avoidance or use loopholes to minimize their tax bill. Many individuals and companies pay their fair share of taxes and contribute to society through various means, including philanthropy and job creation. The reasons why the poor pay taxes while the rich may not be complex and multifaceted. The tax system tends to favor the wealthy, who have access to resources and opportunities to minimize their tax bill. However, with greater understanding and awareness of tax policy and planning. Individuals and businesses can take advantage of available tax breaks and contribute to a fairer and more equitable tax system. The famous author and financial educator Robert Kiyosaki stated, "The poor pay taxes, and the rich don't," in his best-selling book, Rich Dad Poor Dad. According to Kiyosaki, the reason for this is that the rich are able to use various tax loopholes and strategies to minimize their tax burden, while the poor do not have access to these same opportunities. Kiyosaki argues that the rich are able to accumulate wealth by owning assets that appreciate in value, such as real estate or stocks. These assets provide passive income streams that are taxed at a lower rate than ordinary income. In contrast, the poor are often stuck in a cycle of working for earned income, which is taxed at a higher rate. Kiyosaki also highlights the importance of financial education and understanding the tax system and taking advantage of available opportunities. He argues that the wealthy are often more financially literate and have access to resources, such as tax professionals and advisors, who can help them navigate the tax code. Kiyosaki's views on taxes and wealth accumulation have been very helpful to many people around the world. His work has encouraged many people to take control of their financial futures and seek out opportunities for financial education and empowerment. Part 2. If you are conducting research and need accurate and comprehensive information, it is essential to use reliable sources. Reliable sources include academic journals, government reports, and reputable news outlets. When evaluating sources, look for information that is based on facts and data, and not just opinions or biases. To conduct research effectively, you should start by defining your research question and developing a research plan. This plan should include a timeline, a list of sources, and a methodology for data collection and analysis. It is also essential to keep track of your sources and to cite them properly in your research paper. When conducting research, it is important to remain objective and to avoid confirmation bias. Confirmation bias is the tendency to favor information that confirms our existing beliefs, while disregarding information that contradicts them. To avoid confirmation bias, it is important to consider a wide range of sources and viewpoints. Part 3. Expanding the output. In addition to the information provided earlier, there are other important topics related to taxes and research that are worth exploring. One such topic is the impact of taxes on the economy. Taxes can have both positive and negative effects on the economy. On the one hand, taxes can finance public goods and services that are essential for economic growth, such as infrastructure and education. On the other hand, high taxes can discourage investment and innovation, which can lead to slower economic growth. Another topic worth exploring is the role of taxation in social justice. The tax system can be used to promote social justice by redistributing wealth from the rich to the poor. This can be done through progressive tax policies, which tax the rich at a higher rate than the poor. However, the effectiveness of such policies is a matter of debate. Part 4. Tax planning is an important aspect of personal finance. It involves making decisions throughout the year to minimize your tax bill. Tax planning strategies can include contributing to tax-advantaged accounts, maximizing tax deductions and credits, and timing income and expenses to minimize taxes. By engaging in tax planning, you can maximize your after-tax income and achieve your financial goals. Part 5. Taxes also play a significant role in business. Businesses are subject to various taxes, including income tax, payroll tax, and sales tax. Tax planning is essential for businesses to minimize their tax liability and maximize their profits. Business owners should also be aware of tax laws and regulations to ensure compliance and avoid penalties. Part 6. Taxes can also impact investment decisions. For example, taxes on capital gains can reduce investment returns. Investment strategies can include tax-efficient investing, which aims to minimize taxes on investment income and capital gains. By making tax-efficient investment decisions, investors can maximize their returns and achieve their financial goals. Part 7. Estate planning is another area where taxes can have a significant impact. Estate taxes are taxes on the transfer of assets from one generation to another. Estate planning strategies can include making gifts, setting up trusts, and creating a will. By engaging in estate planning, individuals can minimize their estate tax liability and ensure that their assets are distributed according to their wishes. Part 8. Taxes also play a role in retirement planning. Retirement accounts, such as 401ks and IRAs, are subject to different tax rules. Withdrawals from retirement accounts are typically subject to income tax. Retirement planning strategies can include contributing to tax-advantaged accounts, taking advantage of tax credits for retirement savings, and creating a tax-efficient withdrawal strategy. Hey friends! If you are enjoying this video, consider subscribing and turning on the notification bell to receive a notification whenever I post a new video. Part 9. International businesses face additional tax considerations, such as foreign tax credits and transfer pricing. Transfer pricing refers to the practice of pricing goods and services transferred between different parts of a multinational corporation. International tax planning is essential for businesses to minimize their tax liability and comply with international tax laws and regulations. Lastly, taxes are an essential part of our financial lives. Understanding how taxes work and developing tax planning strategies can help us minimize our tax liability and achieve our financial goals. Taxes also impact businesses, investments, estate planning, retirement planning, and international business. By staying informed and engaging in tax planning, we can ensure that taxes work for us, and not against us. Thank you for watching, and we hope that this video was helpful to you. And do not forget to like, comment and subscribe to our channel to see more similar videos in the future.